Good day. Welcome to our budget review brought to you by AJM. Minister of Finance Ericah Shafudah presented the 2025-2026 Midterm Budget review in Parliament on Tuesday. And to help us unpack this, I am joined by Johan Nel, who is the Director of Namibian Tax at AJM, and Oliver Diggle, who is an economist at Cirrus Capital. Good morning, gentlemen.
Good morning. Good morning to you.
Oliver, just to start with you, can you briefly take us through your takeaways from the minister's statement and what stood out to you the most?
Certainly. So the midterm budget was tabled yesterday on the 21st of October. And the first core takeaway I found that despite this being slightly rushed, it was the first budget that this new administration were able to really get their hands on and mess around with, as the one at the beginning of the year was tabled only a week after they came into office. So this one, they've really been able to leave the mark on it. And they've tried to align it with NDP6, so the National Development Plan, and in particular, the second pillar around human development. And that's especially visible in the expenditure part of the budget, where you can see a focus on health and education. So while trying to align it to NDP6 and deliver on the promises of the manifesto as well as implementation plan, they seem to have hit a bit of a wall when it comes to reality. So they got into office on the promise of lots of expenditure and from the government driving growth, but they now have the kind of unpleasant realities of there being a very limited fiscus for the budget as a whole. So trying to square that hole is not a nice place for the administration to be in, when you have huge promises to deliver on and limited capital and limited finances to deliver on said promises. And if that becomes the case, you start to see them making tough decisions and cutting from the development side of things and pushing that onto the operational, more short-term, get out the door sort of funds, which again covers over the cracks in the short term, but leaves possibly unseen cracks in the longer term, which is a concern that runs through this budget as a whole. So coming on to the revenue side of things, the main takeaway is that revenue for this fiscal year is down about 3.2 billion, which is a huge unexpected shortfall. And that comes in both non-tax and tax revenues. And over the medium-term expenditure framework, so the MTEF, the next 3 years of the budget responsibilities, we see a huge shortfall in revenue forecasts. This is opposed to the beginning of the year, where they hugely overestimated potential revenues that would be inflowing into the fiscus. You can see a lot of movement has been moved away from the development towards the operational, which is normal for a budget such as this, but it does show that more and more common nowadays is the development becoming sort of an overdraft facility for the operational budget, with funds just being pulled when needed to cover up the short-term gaps in the spending, which is a concern. So the development budget is down from about 9.6 billion that was estimated at the beginning of the year to around 8.8 billion. So a huge drop off. And they've targeted line items that can be finished within this fiscal year, which is understandable as well. And instead of reallocating funds across the votes, they've decided to pull away from development expenditure, which isn't going to be finished or with the low execution rates, to move towards more of the operational day-to-day spending as well, which is understandable, if not ideal. So you can also see clear decisions were made by the administration with regards to where they were going to put their finances on the expenditure side, with the big winners being healthcare as well as education. Both of those votes are seeing a marked increase in hiring over the MTEF, with huge revenue set aside for that, as well as in education, the promise to fund to free tertiary education for the first quarter of 2026. That funding is being put aside at the present. Okay. So again, this aligns with the national development goals and one of the human development pillars. But again, sacrifices were made elsewhere in the budget in order to fund these deficits. Another concern is that more and more of the funding is pushed away from productive assets towards the operational and towards the salary.
That's concerning.
So while it may cover all of the short-term issues, this does lead to possible negative effects in looking into the long term, which again, as mentioned previously, seems to be a theme of the budget, where the country is going through a bit of a tough period now. It's very similar story to what it was back in 2015, almost a decade ago. So with regards to debt servicing, Namibia finds themselves in a bit of a unique situation at the moment, with weighted average discounts pretty low, so government can borrow a lot of money relatively cheaply as opposed to the past 4 to 5 years, especially following the COVID pandemic. which is good news for the government. So they should be trying to, if they can, borrow as much as they can in the short term, because it's unlikely that that might stay the case for longer, because spreads to the benchmarks in South Africa are widening, which speaks to localized uncertainty in the Namibian economy. And while benchmarks in South Africa are doing well at the moment, and while they have good momentum behind them, that's unlikely to remain the case due to global volatility worldwide. And if that does change direction, if the benchmarks do blow out, maybe we'll no longer have the narrow spreads to protect them. So we can see debt servicing skyrocket, which will then become a huge burden on the fiscus, as already revenues are expected to fall off into the future, and they're going to really struggle to finance all of their expenditures. But coming on to the expenditures again, they have forecast essentially no growth in expenditure over the next 3 years, which is very surprising. Again, they do normally undershoot expenditure forecasts due to Reagan expectations, and it's very unlikely that this will remain the case. And if expenditure does blow out, with the limited revenue we expect to come in, we can expect this debt servicing to blow out as well, because it's highly unlikely that operational expenditure, as stated in the budget, is going to remain flat over the next 3 years. That is almost never the case. So we're bound to see a rise in spending on that front. And if that is the case, they're going to have to find the funding somewhere. And they might have to again pull from the overdraft that is the development budget. But again, funding there has been strapped dry, so there's not much else there. So they're going to have to dig into most likely the local markets who just redeemed the Eurobond. And there doesn't seem to be an appetite or desire to go back out to the international markets for funding.
Thank you so much, Oliver. Coming to you, Mr. Johan, could you maybe walk us through some of the tax-related measures that were mentioned in the statement and what this means for businesses and taxpayers?
Thank you. So I think not a lot was said that's new in terms of this mid-year budget switch. A couple of announcements have been made that they're looking at a medium-term revenue strategy. They're looking at modernizing the tax system and income equality. But in terms of tax amendments specifically, nothing new. They did mention about a reduced corporate tax rate, and we've seen previous mentions about that. So there was a specific mention about the special economic zone, and that's an act that needs to come in very soon. As you may be aware, all the manufacturing incentives and the previous export processing zone regimes are ending end of this year. And there's been nothing put forth that replaces that. And in the budget speech, the minister has mentioned that they predict a decline in manufacturing activities, which I think is not surprising given that there's no further tax incentives for them to do something. So specific mention was then made as well about small and medium enterprises and a reduced corporate tax rate of 20%. Now, we've seen some draft legislation, and it's been circulated quite widely in the industry. There will be certain requirements. Initial indications were that if you are less than 10 million turnover, 10 million Namibian dollars per annum, had provided certain other requirements are met, that you can benefit from that 20% corporate tax rate, which I think is a welcome amendment, and hopefully it comes through quite soon. Another one that's being talked about a lot is the introduction of dividends tax from the beginning of next year. So any dividends that will be declared and paid after the 1st of January 2026 will be subject to a 10% dividend withholding tax. Currently, there's no dividends tax unless you declare it to a non-resident. So this adds to the cost of doing business in Namibia. It adds to returns, and there's a lot of commentary and views around what this will do to investment and also to the money that goes back into the market. The tax rate for non-mining companies also predicted to go down to 28%, which aligns nicely with the rest of the region. Still a bit higher than some of our neighboring countries, but at least it goes down. Currently it's still at 31%, so the plan is to take that down to 28%. Then there was an interesting mention about small and medium enterprises importing goods and creating a simplified importing structure, so they don't need specific clearing agents and that they can do a self-declaration, which I think will benefit a lot for small and medium enterprises. The minister mentioned that they, in terms of tax compliance and administrative burden and the cost and all of that, that they will lengthen the validity of the good standing certificates. I think it's a nice gesture. But the cost of doing business and the cost of administering taxes is not only for the good standing certificates. it's the constant delays with refunds and objections and appeals, the fact that we don't have a tax court. All of that plays a role in taxpayers having to spend money to pay consultants or to put away resources of their own in order to solve these issues. Unfortunately, NAMRA has become quite aggressive, which I think is necessary because there are large-scale tax avoidance and tax evasion schemes happening in this country, but everybody's not the same. We cannot treat all taxpayers the same, and there needs to be a revised way of looking at the risk of each taxpayer. And advanced economists have done this to say, if you are looking at a bank that is listed, the reputational damage of getting your taxes wrong is significant. So it's unlikely that they will try and cheat the taxes. Also, if you have a number of clean audits, why do you want to keep on auditing every single VAT refund if the outcome is always the same and there's no real issues? There was a mention about revenues declining because VAT refunds are increasing. Now, that is quite a bold statement. I don't think one should rely on VAT refunds or VAT not being claimed back as a way of increasing your revenue. VAT refunds will increase when the economy starts growing. And especially when it comes to capital projects, and we see a lot of startups with mines, we see something in the green hydrogen space happening. There will be importation of equipment, there will be imports of skills, and sometimes this relates to, or this results in a claiming back of the VAT. And it's not a loss to the fiscus, but it is a cost. But if people don't get that money back, it increases the cost of operating in Namibia. And that could, if that is an issue, which currently, unfortunately, it is for a lot of large-scale capital projects, it just delays investment decisions further. And as you've seen, and as Oliver has mentioned, revenue is declining. The economic outlook in terms of our growth has gone down to, I think, 3.3%. So it's constantly being revised downward. So we should be very careful in how we shape tax policies and decisions, and specifically incentives, about to get this ball rolling, to create more revenue. Because the more revenue we create, and it's not only about getting corporate tax, it's not only about getting VAT, it's about the more jobs we create, the more people get employed. All those people that get employed pay a thing called pay as you earn, or employees taxes. You will see in the budget speech, as I mentioned, that personal income tax growth has actually sort of flattened out or reduced a bit. And I think that's indicative of the fact that we're not creating enough jobs. There has been a number of retrenchments in certain industries. And if people's wages don't increase, the tax won't increase. Specific mention was also made with regards to the tax system for long-term insurance companies. So currently they are being taxed on their investment income. And there's a change coming in how that tax system will work. So I don't think it's particularly welcomed by the industry, but comments have been made and commentary has been submitted to the Ministry of Finance regarding this piece of legislation. Previous income tax amendments that have been mentioned that has not been specifically outlined in this budget speech, I think it's important to note that there will be an increase in the single commutation payment that can take place from your pension funds. At the budget speech this year, at the beginning, there was a mention made of hybrid equity instruments and changing the legislation on that. So for a long time, Namibia, if you do financing deals and you use preference share, you use other types of arrangements involving equity, that you can pay a dividend as a return instead of interest. Now, as we know, dividends currently are exempt of tax. So if you receive a dividend as an individual or as a company, you're not subject to tax on it. The idea behind this hybrid equity mismatch arrangements, as the OECD calls it, is that if people are trying to shift profits out of Namibia's jurisdiction, or if they're using something where they basically disguising a transaction to get an unfair tax advantage, that those instruments should be deemed to be interest and not dividends. Now, in the case of Namibia, it's not that relevant because dividends are not deductible for tax and it's not subject to tax. Interest is deductible, but it is subject to tax for the person receiving it. So putting in something like this is probably not entirely necessary. Some other jurisdictions that put it in will, for instance, say to the extent that this arrangement results in a tax deduction for one and not being taxed in the hands of the other person, that they will deem this arrangement to be a financing arrangement, and therefore the interest would be, or the deemed dividend would be subject to tax. Lastly, there was the mention in the budget speech previously this year about VAT on imported digital services. Again, something quite common across Africa, meaning that if you make use of digital services or imported services, things like Netflix, Amazon, certain license fees, that there will be a imported charge on that. Technically, if you speak to the right people, if we use services and it's not for business purposes, so any person basically that doesn't render taxable supplies, anything that you import as a service that you don't use in furthering your taxable supplies would be subject to import VAT on services. It's very difficult to enforce. So this new legislation that's probably going to come in is going to put a more modernized framework. It's almost like some people refer to it as a reverse VAT charge. So the moment that services are imported by a business and that is from a foreigner, there will be a import VAT on digital services. So we're waiting for more draft legislation and commentary on that.
This midterm budget does indicate a primary deficit for this financial year, which is a huge swing down from a primary surplus estimated in the beginning of the year. However, this bounces back quickly over the next 3 years, going back into surplus territory, which we believe is highly unlikely to actually materialize, especially if expenditure is going to increase above what's mentioned in the budget itself. Again, on a GDP front, growth has been pushed down sizably, down into the mid 3% from the mid 4% for this financial year, as well as going forward. And this is a concern for the government because less growth in the economy means less revenue that they can extract to finance all of their expenditure duties. So this is a concern for the government, as in less growth in the economy means that they can extract less revenue to finance their expenditure bills. But hopefully this indicates to the government that they won't be able to put themselves at the center of growth for the country, which they try to do so as laid out in NDP6 and the implementation plan. And hopefully this gives them the hint, gives them the nudge to just let them create the right operating environment, and then let the private side of the nation take control of pushing growth and increasing employment and dealing with the macro sense in that front. This budget looks like we're heading back towards some form of austerity with limited rises in expenditure. Essentially, it's almost flat over the next few years, which, due to the fact that revenue forecasts are just not there to finance what needs to be financed from the government point of view. So while we think this is unlikely, going to austerity that is, and we do expect expenditure to balloon somewhat, this in turn will come at the cost of debt, and most likely local debt. And that's going to undo all the good work that the previous administration did in order to get the fiscus in a sensible and in the way that it is at the moment. So moving forward, it is a huge concern, this budget laid out, in the fact that the promises do not align with what the revenues. So going forward, this is a huge concern, the budget that was laid out, in that the revenue does not align with the expenditure promises that were laid out by the party in the beginning of the year and in their implementation plan and NDP6.
That's an interesting point.
There was specific mention about also our tax strategy, or looking at the tax policy and looking at some incentives that's being provided. But overall, with regards to tax, keep mentioning tax to GDP ratio. Namibia, as far as I know, is probably got the best tax to GDP ratio in Africa and quite up there in the world. So I think the issue is not necessarily tax collection. We are collecting taxes. Yes, we can do better, and that make it easier for people to pay tax. But the tax GDP ratio is not the issue. We're actually collecting a lot relative to GDP. The issue is, how are we spending the money? And talking to what Oliver has said, it's not about necessarily the revenue side. Yes, the revenue is important to collect, but how are we administering these funds? How are we spending it? Are we spending enough on development areas and not on operational areas to get the economy growing and in the long term have a positive effect? So I know there's quite a few views on, are we efficiently managing or spending the money that we're actually collecting?
Gentlemen, thank you so much for your insights. There were some key highlights from the 2025-2026 midterm budget review. Thank you so much for watching, and don't forget to follow us on all our social media platforms for more videos.